You've just watched a video about a high school con artist who made millions ripping people off. Have you ever found a website offering something that sounds too good to be true?
I'm sure my money will be safe at BigAlsCashFarm.com. Now, where's my credit card?
Okay, so now you're ready to make your investment, and you bring up the stock quote on your computer. Remember, the quote will show you the bid and ask prices at that particular time of the day. The stock price is constantly on the move during the trading day and is partially driven by supply and demand. But what is a fair price? In theory, if all investors have access to the same information, they all will be able to make an informed decision about the stock's value. We say that information is material if its disclosure will likely impact the value of the stock, or if investors would like to have this information before making their investment decision. In reality, managers and executives may be privy to information about company operations that is not known to the public. Others, such as investment bankers, may have information of an upcoming merger offer, or external auditors may have found significant accounting discrepancies which might affect the price of the security. These are all important facts, but until they are fully disclosed to the public, we call them non-public information, and those that are in possession of this knowledge are called insiders. Let's see what you would do as a potential investor in the following situation. Avi is 18, and with the help of her mom, she has opened up a trading account and started to build her investment portfolio. She already has a couple of blue-chip stocks, some mutual funds, and corporate bonds. She is always reading about current events that may affect the stock market. One day at school, she receives a tip from a friend whose mother is a stockbroker. She said that the Red Turtle Company is about to merge with a much more successful company. Avi thinks that this might have a positive effect on the value of the stock. So she hurries to place a trade to buy 50 shares of the company. She really wanted to get a jump on this before the merger announcement went public. Let's think about the advantages and disadvantages of making a decision based on this example. What would you do in this situation? Do you think Avi's an insider? Did she trade on insider information?
Guilty on both counts. Avi, her friend, and her friend's mom are totally insiders. TISNC.
If Avi profited from buying the stock before other investors had this information, how does that make you feel as an investor?
That ticks me off. There's a fair disclosure rule that says every investor should have that info.
Should those with inside information be banned from making investments before this information is made public?
Absolutely. That's an unfair advantage.
What Avi did is considered insider trading. Investors can go to jail for that. It is up to the company to issue a public press release so that all information may be shared with investors at the same time. It is also illegal for a person with inside information to pass it along to a third party who then uses it to make investment profits. Have you ever heard of the expression, if it sounds too good to be true, it probably is? Scam artists, like the one we saw in the video, are just waiting to take advantage of investors and steal their hard-earned money. One of the ways to protect yourself is to learn about their different schemes. One very common scam is a Ponzi scheme. It's an investment scam designed to separate investors from their money. It is named after Charles Ponzi, who constructed one such scheme back in the early 1900s, although the concept was known long before then. Here's how it works. Investors are convinced to invest in the fraudulent scheme because they are promised really large profits. No investments are actually made by the so-called investment firm. Early investors are paid their returns with the invested capital received from subsequent investors. Eventually, it becomes much more difficult to find new investors, or the scam artist feels that enough money has been collected. When this happens, they simply take the money and run. One of the largest Ponzi schemes in recent history was carried out by Bernie Madoff. In December 2008, it was estimated that he took $65 billion from unsuspecting investors over a period of nearly 20 years. Madoff was sentenced to 150 years in jail for his scam. Another example of an investment fraud is called a Forex scam. These scams often find their victims through ads placed in newspapers, TV, or websites. The ads look quite legitimate and offer an exciting opportunity to invest in the foreign exchange market. Sometimes they try to sell you special software or have you sign up for trading classes. What usually happens is that your money is not invested in anything at all. You'll simply be saying adios to your cash. Still another variation is the investment seminar scam. These seminars offer you the opportunity to make investments that will ease your tax bill. Most often, these seminars are selling an investment with some kind of tax break or tax shelter. Taxes are a reality in life, and any promise to eliminate them is definitely an investment scam.
Remember what Ben Franklin said, "The only things certain in the world are death and taxes."
Yet another scam that tends to resurface from time to time is the West African or Nigerian letter scam. Here's how it works. Potential victims receive an email, fax, or personalized letter from someone posing as a high-ranking government official from a developing country. The letter says that there is a large amount of unclaimed money that they can access with your assistance. Your reward is a large chunk of these unclaimed funds. They'll request that you send them some money up front, which will allow them to retrieve this fortune on your behalf. We call this an advanced fee fraud. In the end, you won't see a dime of these unclaimed funds because they simply never existed in the first place.
In this video, we saw how a fair price is reflected in trading volume at various bid and ask prices. There is public and non-public information when it comes to stock value. If financial information is made available to everyone, that is called public information. If, for instance, a handful of executives know about an upcoming merger, that is known as non-public information. Insider trading occurs when some investors use non-public information to buy or sell certain stocks. Other pitfalls for investors to avoid include Ponzi schemes, the Forex scam, the investment seminar scam, and the West Indian or Nigerian letter scam. The common thread is the promise of big returns for very little money.
We can see that if something sounds too good to be true, it probably is. Falling for these scams will only separate you from your hard-earned money. Be aware, ask questions, and if you're the least bit skeptical, don't give them any of your money. Now that you're a wise and savvy investor, it's time to play a game where you'll experience the ups and the downs of the stock market.